Hello, grade 12s. Welcome back from the short break. We are still busy with the fiscal and the monetary policies as part of the strategy that the government or part of a method that the government can use in order to manage the business cycles. So we're going to continue and look at the different policy instruments, and then we're going to start with an open market transaction, which is the South African Reserve Bank can directly increase or decrease the supply of money by buying, selling government goods, by buying and selling government securities in an open market. Okay, so that's another way that the South African Reserve Bank can actually increase or decrease the supply of money. So it's all by buying, or we can say selling government securities in an open market. Okay, so obviously when they are buying more government or they're buying, that will ensure that we experience an increase or a decrease in an open market. And then also they can use the interest rates if the banks experience a shortage of funds in the money market. They are accommodated by the South African Reserve Bank when they are allowed to borrow money through a repo system, which is a repurchase tender system at a rate known as the repo rate. Okay, we spoke about this earlier on. We said if banks don't have enough money available, they can approach the South African Reserve Bank. So when I say banks, I'm referring to the commercial banks, and then they could take out a loan, but they have to be charged because they also charge us if we take out a loan from a commercial bank. So the banks charged what we call a repo rate. And then when we take out a loan in a commercial bank, we are charged an interest rate. So obviously, if the Reserve Bank decides to increase their repo rate, the banks will also increase their interest rates so that there is an equal balance in the amount of money that they have taken out and the amount of money that they have to pay back. So by increasing this rate, okay, money becomes more expensive for commercial banks. So we are referring to the repo rate. So when the South African Reserve Bank increases, just going to do a joint here, the repo rate, that means that money becomes expensive for commercial banks, who pass on the increase to their clients by increasing interest rates on loans. Okay, so if you have taken out a loan from a commercial bank and the banks have also just experienced an increase from the Reserve Bank, so they will also then try and make up for it by increasing the interest rate that they charge on loans. So loans become more expensive to the consumer, and so the demand for money will decrease. Okay, so if you know that the interest rates are high, then somehow you will be discouraged to take out a loan at that particular time, because you would rather wait for the interest rate to be dropped so that you can approach a commercial bank to apply for a loan. Because if you go at a time where the interest rates are quite high, then you will find yourself having to pay more interest on the initial loan that you have taken out with that particular financial bank or that commercial bank. Okay, so we can see that this relationship is important, and the fact that the South African Reserve Bank will be in a position to loan or to borrow money to the banks. And then they will be charged a percentage through the repo rate, which is known as the repurchase tender system. And then we know that the interest rate will also increase as a result that the bank has increased its repo rate, which has made money to become more expensive, and therefore the banks will then pass on the increase to their clients, and then they will charge higher interest rates. Okay. And then the cash reserve requirements. So the South African Reserve Bank is permitted by the Banks Act to occasionally change the minimum cash balances that banks are required to maintain in order to manipulate the money creation activities of the banks. C, the money multiplier equation, change the 5% to 10% and see what the effect would be on the creation of credit or money in the economy. Okay, we know that banks are also in a business of making money. So occasionally the South African Reserve Bank will actually permit for the banks to change the minimum cash balance that they are required to maintain because they want to be in a position where they can generate more money in the economy. So this doesn't happen quite often, hence we emphasize on the word occasionally. So it doesn't happen quite often where the Reserve Bank will make this decision. And if you go back to the previous multiplier equation that we had earlier on, and you change the 5% to the 10%, and then you will see that the amount, the 20,000 that we worked out earlier on, will then go up. So it is a way to manipulate the money creation activities of the bank. But all that you need to remember is that this does not happen often. It happens occasionally where the Reserve Bank would grant for this to happen. Okay, so let's just go back before we move on. Okay, there we are. All right, so now let's have a look at the fiscal policy. So fiscal policy is the process of using taxation and public expenditure to even out the swings of the business cycle. Okay, so we know we've got the upward swings and then the downward swings. So government can't use the process of taxation and public expenditure to influence the swings of the business cycle. So governments, through their fiscal policy, have a powerful weapon for stabilizing or ironing out or smoothing out the business cycles to stop the peaks from ending in high inflation and the troughs in too high levels of unemployment. In the previous lesson, we discussed the two concepts in great detail. We said that a peak is the highest point in the upswing, so it will be there, and then a trough will be the lowest point in the downward swing of the business cycle. Okay, but here the government will do this in order to avoid high inflation and also to make sure that we don't have too high levels of unemployment. Okay, so that is why the government could use fiscal policy to stabilize or to iron out the cycles in order to stop peaks from ending in a high inflation and the troughs in too high levels of unemployment. Because we said in this particular point, it means that there's less economic activity and therefore consumers or households are unable to find employment or are unable to sell their effective inputs into the firms, and therefore they are not generating any income. So the relationship between production, income and spending is affected because there's less economic activity happening during this particular point in the economy. While the monetary policy focuses on managing the total money supply, the fiscal policy tries to stimulate or curb the economy by increasing or decreasing total consumption expenditure. Okay, so here when we look at the fiscal policy, so the monetary policy will focus on managing the total money supply, whereas the fiscal policy tries to stimulate or curb the economy by increasing or decreasing the total consumption expenditure. Okay, so this actually distinguishes between these two policies, because students often get confused between these two policies, that the monetary policy will focus on the total supply of money, and the fiscal policy will try and stimulate or curb the economy by increasing or decreasing the total consumption expenditure. So the fiscal policy is dependent on the multiplier effect, where a relatively small change in spending will cause a large change in income, which is the GDP. Hence, we can see the link, because in the previous lesson, we also looked at the multiplier effect. We looked at the relationship between production, income, and spending. Okay, so if there is a small change in spending, this could cause a large change in income. Okay, so if people are spending, it means that more people are receiving an income, and therefore production will also increase, and hence we bring in the GDP, which looks at the number of goods and services that are produced within a particular country. So fiscal policy plays a very important role in ensuring that it stimulates the economy also, but also it does curb the economy where necessary. And then now let's look at the original equilibrium situation. Okay, so here it accepts that all economic activities, so just go up again. So all economic activities are stable and all markets are in equilibrium. Assumes the beginning of the following or understand conditions or problems. Okay, so here we assume that all economic activities are stable and that all markets are in equilibrium. So that's the original equilibrium solution. Remember, when we looked at the diagram of a business cycle in our previous lesson, we looked at the original equilibrium point or situation, and then also we looked at the movement that could happen where the original equilibrium moves, and it moves because there's been a change in investment, for example, and that change has caused the original equilibrium to move. And then the next point looks at the total demand. The total demand is low and unemployment is high. Okay, so when the total demand is low and unemployment is high, so the state can increase total demand by increasing expenditure, so they're spending more money, and the multiplier will kick in, because the more money you spend, then the more income consumers or households will have, and then that will increase the economic activity. Hence, I like the term that we used over here, to stimulate, because what they have done here with this particular strategy, they stimulating economic activity by increasing the expenditure, so that there can be more economic activity, and therefore after that the multiplier effect then kicks in, where we are receiving income but we are spending it, and when we spend it, that income becomes the next person's income, and therefore production also increases, and also there is more economic activity happening at this particular point. So that's a good strategy to have in terms of looking at the fiscal policy. So the state has three options, so we're now going to look at those options. The first option is raising government spending with borrowed money, which is a budget deficit. Aggregate expenditure increases, and so does demand. So the economy is stimulated and employment is likely to increase. Okay, so we borrow money, so the state, so remember this is government spending, borrow money, and that's known as a budget deficit. and then aggregate expenditure will increase as a result of that decision, and so does demand. Therefore, the economy is stimulated and employment is likely to increase. When employment increases, then there is more economic activity. It means that the households are receiving income and they are able to spend. Okay, so going back to the multiplier effect, so it's been stimulated and now it has kicked in because of the increase in aggregate expenditure and also the fact that the unemployment or the employment it has increased and the high unemployment has decreased. Okay, so then also they can do the next system or strategy, decreasing taxes. Consumers and producers have a larger part of their income available to spend on goods and services. Aggregate expenditure increases, the economy is stimulated, and employment is likely to increase. Okay, so we mentioned this in our previous lesson. We said this could be an ideal situation for consumers because now they have more money in their pockets to spend, and therefore the fact that the taxes have been cut down, it allows them to have more income. The fact that they've got more income, it means they can spend more buying consumer goods or goods and services that they need. And this will also result in employment increasing because of the economic activity that is happening in the country. Raising government spending and simultaneously decreasing taxes. So that's a combination of the two systems that or options that the government can use. So you decrease your taxes, but also you raise the government expenditure in order to make sure that the economy is stimulated, that the consumers have more income in their pockets to spend, because if they do this, if they spend, it means that there is more economic activity, and then that will mean that the employment is likely to increase as well. So what we're going to do now, I know things are warming up and we are into it. Let's take a short break and I will see you right after this.